Names that move markets are on Bloomberg.
Our budget proposes an additional $3 trillion of deficit reduction over 10 years. And I think that's necessary to make sure that our fiscal path is sustainable. Now, Congress hasn't done anything, beyond what I've mentioned to improve the fiscal outlook, and I think that's a shame.
Nobody covers business like Bloomberg.
Welcome back to our television and radio audiences. I'm Shonali Bassick alongside Vonnie Quinn. You are watching Bloomberg Markets, and we are looking at a day that is an interesting trade, low on volumes, but an S&P 500 trying to kick back into the green above 6,000, and a bond market that has gotten a bid back once again, Vonnie.
Yeah, it's interesting. The 10-year yield at 4.57 now, so we're well away from the heights that we saw this time round. But of course, the Fed Fund futures have repriced everything once again, Shonali, and now looks like almost impossible that we'll get a cut in January and maybe not even in March.
Absolutely incredible. And under the hood, I've been looking at this story about just funding stresses under the surface. Repo rates have actually been spiking, even though you look at that relative calm in the bond market. Pretty interesting to keep a lookout on. We will talk more about that bond market later in the show.
And the 2-year yield, just as you're watching it there, 4.33. We also have the 30-year yield at 4.76. So some commentators reflecting that it's still going to be a steepening trade, and also some money coming out of bonds as well. I mean, with the equity markets at all-time highs, why wouldn't you put your money in equities, right?
Absolutely. And we're going to switch gears here. We're going to now talk a little bit more about the politics portion of this. Of course, a lot of people in the bond market watching those long-term rates as it pertains to what is happening with the fiscal situation of the United States. But remember, a lot of that comes down now to not just the president-elect, but also to Elon Musk. Elon Musk blurring the lines between reality and the internet culture, even bringing Doge to the White House. What started as an internet meme in the early 2010s is now Musk's latest pet project under President-elect Trump. Bloomberg's Matt Miller has more.
Alongside Vivek Ramaswamy, Elon Musk is set to lead the Department of Government Efficiency, or DOGE. Get it? We know Musk loves memes, the internet, and Twitter, which is why he spent $44 billion to buy the company back in 2022. The question now is, will that affinity for lols translate into effective government policy? According to Trump, the department will effort plans to eliminate fraud and improper payments and will conduct financial and performance audits across the federal government. But already a clear winner is emerging from the creation of the DOGE. Backers of Dogecoin saw the alt cryptocurrency spike since Donald Trump's election win, driven in part by optimism over Trump's digital currency stance and then aided by the DOGE announcement. Musk says the department will instate a leaderboard posted online for, as he puts it, insanely dumb spending. So the next few years may see America operate as the land of the meme as policy becomes even more public.
And of course, that was Bloomberg's Matt Miller there talking to us about Elon Musk being very close to the White House. Now, we want to talk to somebody in BN who's been following this very closely, specifically who Elon Musk has taken on with him to work at Doge. Bloomberg's Anne Vandermeer joins us now. So Steve Davis is the man, and we know a little bit about him. He's working at the Department of Government Efficiency. What does this mean for, the next year and for federal jobs, essentially, Anne?
Well, that is a great question. It is still such an open question what Doge is going to look like. We know that it is called the Department of Government Efficiency, but we don't think it is really going to be part of the government. Right now, it is kind of more of an advisory council, and so Elon Musk has taken on Steve Davis, who is a very loyal deputy, has been working for Elon Musk for about 20 years, more than 20 years. And he is helping staff up this effort. As of a little bit earlier this month, there were about 10 people on board so far. So it's coming together, but it's still a little bit unclear what the priorities are going to be. It's a bit vague at this point.
you know, Musk has gotten some criticism already. This whole kind of joke, if you call it, that you're running a Department of Government Efficiency with 2 people at the helm, and you're saying 10 more people now being brought on board for an initiative that has not yet been made clear. How efficient will this be? And at the end of the day, to the point you're making, some of these people are serving kind of 2 roles at once, aren't they? They're keeping their day jobs.
Yes. So Steve Davis right now, he is working as president of Elon Musk's tunneling company, which is called the Boring Company. And he's also working with Michael Kratsios to help staff up this organization. It's, you know, it could slash government spending. That seems to be the goal, but it's still pretty unclear, you know, sort of what they'll go after, how much they'll cut, and what sort of things they will end up targeting. So, you know, it's hard to say how many people they'll end up with. It may or may not be efficient per se, but so far we know that they are recruiting.
Give us a little bit of his bio, and we know that he's worked with Elon Musk. This is Steve Davis now since 2003. That's 21 years in places like SpaceX and the Boring Company, but he also worked at a yogurt store at one point.
Yes, he has a very unusual biography. He has 2 master's degrees, one in particle physics and one in aerospace engineering. He started out working at SpaceX. He ended up working at the Boring Company. He also was brought on to help with Twitter. But in between, he operated a yogurt store called Mr. Yogato that was known for sort of unusual gimmicks. You could answer trivia questions and get a discount on your yogurt. He also had a bar called Thomas Foolery that was known for, again, gimmicks. They had an angry hour as opposed to a happy hour where you could get a discount if you shouted your drink orders. So all in all, this is a very kind of unusual character for either really the tech industry or certainly the government.
And we thank you so very much for your time. Of course, this is one of the most read stories on the Bloomberg Terminal. You're not going to want to miss on Bloomberg Terminal or on Bloomberg.com exactly how Musk is going about hiring one of his top deputies, longtime deputies, to go about Doge. We're going to now bring in Jennifer Greigel. She's associate professor of communications in Syracuse University for more on Musk, Trump, and the future of social media under the new administration. So we're looking at what the president-elect might do moving forward. We're trying to read the tea leaves. How do you think social media is going to play a role in the upcoming world? I mean, how do you think they're going to really use Musk's platforms relative to some of the other more established ones you've seen out there?
Yeah, hello. Well, maybe a little context, because I know over the last 4 years, I've kind of been sitting back a little bit more and watching this all play out. And I know Musk is the person of the moment, and we're throwing around these like sophisticated terms like retail investors, but like it's really about the public sometimes. The market's trying to make sense of what's going on. And for me, the one piece that I've seen lacking in the media over the last 4 years, and especially this past year, is any critique of really the Biden administration and how they've handled not just like their leverage over social media, but even this upcoming potential TikTok ban that's looming, and now it's going to the Supreme Court. And I know you're just talking about meme stocks and also Bitcoin, like it or not, President Trump is coming to power next year, and he has an incredible amount of leverage, ability to cut deals, not just with TikTok, but any of those competitors. So, again, circling back to Facebook, it's no surprise that, kind of late in the last election, you saw people like Mark Zuckerberg, kind of maybe, kind of cozying up a little bit more. And I think it's because we were missing that context. I know for me, it was really difficult to cut through at times and to provide that critique, but I'm not sure the markets or the public have really heard enough critique going into this. It's been really focused on Musk. And obviously, he has the president's ear. Again, I know there's jokes about him being the unelected president. Of course, he's incredibly rich, and he has Twitter, but he has made that work for him. So for me, I think we just need a little bit more history and looking into, those who were in power. I think they had a lot of confidence going into this that Biden would continue, and then they passed laws like that too. So I think it's going to be actually unsettling to some of those larger social media companies. I'm not sure, again, their future is so sure, and that we should only be talking about TikTok, for example.
Yeah, Jennifer, I mean, what would Donald Trump like to do? Because on the one hand, he needs leverage with a country like China, especially if he's going to be imposing extra tariffs and so on. And this seems sort of like a, easy pickings, if you like.
It's exactly. And he's got easy pickings with Bitcoin. Do you make a reserve or don't you, right? So he has so many levers going into this next term, right? So I think when we think about, I was taking some notes, looking at the last section, this is not a moment of clarity. Like, we do not have confidence. We don't have certainty. And I think the markets are reacting to that more than just this Fed, announcement. Obviously, we saw a major market moment there, but I see uncertainty coming into the end of the year, not just because it's the end of the year, but because we really don't know how President Trump is going to play his cards. We just know that he has a lot in his hand.
And Jennifer, all these tech executives that are visiting Mar-a-Lago and, digging deep for their $1 million or whatever it's costing them, and these U.S. executives, I mean, in particular, what will that buy them?
Yeah. Well, that was what was interesting about the TikTok case, was that they went to extraordinary lengths to legislate, to carve out TikTok. Otherwise, it would have looked just like every other platform. Facebook would have been in the same situation. And that was kind of what I think gave TikTok comfort for a while. I think going into this legislative path was incredibly risky. It is a huge threat to freedom of information, freedom of expression. Unfortunately, again, even the expiration date was right in front of the next term. It was, I believe, just an incredibly dangerous piece of legislation to target one platform like that. It doesn't matter if it was an external, kind of foreign actor or whatever the reasoning was. It was very, very targeted, and the timing, would have given the Biden administration some leverage, not only with TikTok, but with maybe the sitting platforms going into the last election. They could have maybe, struck some type of sweetheart deal with Facebook. So it's really, again, we have to look at the timing of all of that. That was passed in April of last year.
Right.
March, we knew in March Trump was taking the helm at the RNC. Again, I don't like it. I don't like it.
But Professor, you look at how TikTok has been treated by lawmakers, and you've seen both parties really voice their concerns. At the end of the day, do you think that whether or not there is a full-on ban that is pursued in the early days of a Trump administration, or a wholesale sale of the platform, does that pressure really go away?
Well, and great point. Again, I'm just trying to sneak in just a tiny piece of critique on Biden here, because we really haven't seen it. I mean, that's just been my experience in the last 4 years, and I haven't seen it much in the media. But as you point out, it was like bipartisan to get that through. But that, again, is something that is telling. I think that on both sides of the aisle, that President Trump was a threat, and that it wasn't just Biden per se, but it was all of the incumbents. And we saw this actually way back this reminds me, honestly, of 2012, when we saw under the Obama administration, they instituted the modernization of what was called the Smith-Mundt Act. And, again, Trump was starting to make waves at that time, starting to maybe, put his hat in the presidential ring. And the incumbents were bipartisan. It's a little bit of a gatekeeping action from those who are currently in Congress, in the White House, saying, hey, we don't want this outsider maybe coming in, So it spoke to maybe the political climate of those who were sitting in power too, that maybe they were trying to gatekeep a little bit. But I just believe that it gave an incredible amount of leverage to any incumbent at that time.
Jennifer, thank you so much. That is Jennifer Greigel. They are Associate Professor at Syracuse University. Once again, Jennifer Greigel joining us there. And with Bitcoin down 2.5% right now, we will be speaking about the coin next.
In case case you missed it on Bloomberg Technology.
I believe that we would love OpenAI models inside of AWS. Absolutely. It's we listen to our customers, and if that's something that customers want, we're absolutely game. Obviously, with a partnership, it takes multiple sources, and there's probably some complexities in there, as you allude to. But I think in the fullness of time, it likely is the case.
Don't miss Bloomberg Technology, live every weekday.
We felt strongly that there has been an opportunity for there to be an experience on mobile that is centered around gamers. Like, we talk a lot about how there's 3 billion gamers in the world. 2 of those billion play on mobile, and half of those actually play on mobile and they play on another device. But there isn't actually a gaming platform and store experience that is centered around players and goes truly across device, where who you are, your library, your identity, your rewards, that travels with you versus being locked to a single ecosystem. And we've recognized that opportunity for a long time, but we wanted to make sure that anything we built was really grounded in people who play those mobile native games and the creators of them. And so being joined with a team that has real deep expertise in mobile was important to us.
A continent of vast opportunity and endless potential, but not without its challenges. Bloomberg highlights the players and unpacks the issues shaping the African story. We'll bring you interviews with key newsmakers and expert analysis, getting to the heart of business, politics, and economics in the region. I'm Jennifer Zabasaja, and this is Africa Amplified.
This is Bloomberg Markets. I'm Bonnie Quinn along with Shonali Basak, and we have about 45 minutes left in the Thursday trade. A holiday shortened week, we have to mention. Obviously, everybody knows this. Volume very, very light. But it has been a record-breaking year in the crypto market, Shonali, even though we've seen it come off the boil in the last few days. Up 130% this year for Bitcoin. Momentum from Elon Musk and President-elect Donald Trump helping drive the coin to new highs. It hit more than $108,000 a coin earlier this month, of course. The stock down from those highs today at $95,500 roughly now. For more, we're joined by Bloomberg crypto reporter Muyao Shen. So Muyao, how do we know how to even forecast what's going to happen with crypto next year?
I think Bitcoin has a very tremendous year so far, as you just mentioned, and there's a couple things that people are looking at going into the next year. I think first of all, MicroStrategy, which has been the main driver of the market in the past year, buying all the Bitcoin. I think people are looking forward, continue keep an eye on whether MicroStrategy are buying more Bitcoin. Another thing is whether there are other public companies that are going to deploy similar strategies to buy Bitcoin and put it in their reserve. And I think another thing that's really huge, as you mentioned, the President-elect Donald Trump has had also a very powerful impact on the market, and people are hoping to see whether he's going to keep his promise of creating a so-called Bitcoin strategic reserve for the United States. I think that's also going to have a huge impact on the markets, and I'm pretty sure traders and market has been positioning around whether this is going to happen, in the coming months.
I mean, I would note that when it comes to that idea for a strategic Bitcoin reserve, there are a lot of skeptics. Yeah. What happens if he does not go ahead and do that, given what a run-up we've seen in Bitcoin because of a lot of the promises put forward?
That's a very interesting question, because I do feel like I've heard a lot of skepticism from within the crypto market. We see, for example, Galaxy Michael Novogratz has been very outspoken. Right? He's like, look, I would be happy if we create a Bitcoin reserve, but he just doesn't think that's going to happen. So I feel like market has been having this good balance between like the very pro Bitcoin reserve and those who are not really optimistic about it. shares. So I don't think it will have major impact in terms of, whether you have like a huge like upset to the market and prices.
Can I ask you about MicroStrategy? Because we have seen it, first of all, it entered the NASDAQ 100, looking to enter the S&P next year, but it's down another 5% today. This idea that, it's going to issue more shares or apply to issue more shares in order to buy more Bitcoin seems like it should send the stock lower, no? Why would that be a good plan? It's diluting the shares.
You got me on that question too. Yeah, I've been asking everyone literally every day when I call like sources, traders. I was like, what do you think about MicroStrategy prices? And my understanding is that people are still relatively positive. They were like, the price is gonna correct at some point for MicroStrategy, but they don't think that's gonna happen in any near term, like not even like in the next year or so. That's something quite like shocked me as well. I feel like part of it, they do have the psychological being played, I think, into the market at the moment, and people are more bullish than bearish.
Yeah, I mean, even if you look at the analysts, there are 8 of them, 8 buys, and the lowest price target is $480. The highest is $650 from Benchmark Company. I don't know if there's something that we're missing or not, but that's just it. Donald Trump talking about the rest of the Bitcoin that we're going to see being made in the USA. Is that even possible? You can't tell people in India and in China and wherever else they might be still mining Bitcoin that they can't mine, can you?
Yeah.
Isn't that the whole point of Bitcoin in the first place?
I know he said it during his campaign. Obviously, it gave a boost to all the U.S.-based Bitcoin investors, right? But first of all, it is very hard to make, and also, like, I think a big part of the crypto industry also don't want that, because Bitcoin ultimately is a decentralized crypto asset, right? If you make it the rest of Bitcoin being mined in the USA, that also goes against like the whole idea of Bitcoin.
Exactly.
Yeah.
The whole ethos is that the government, shouldn't have a say.
But made in America is certainly at least the campaign promise for now. And we thank you for joining us. That is Muya Shen, of course, covers crypto for us here at Bloomberg News. Now, markets appear to be ending the year on a high note, but there's a perspective on Wall Street that U.S. equities are due for a downturn. Interactive Brokers Group, Thomas Petterfy, he's the chairman there, holds just that concern. He recently spoke with me about that, and here are his thoughts about cryptocurrency as well.
I'm afraid that the markets are becoming overextended, and that sometime in the future we will have a downturn in the markets. But I don't think it's going to be a very violent and very far. It will not go very far. So I'm extremely optimistic about the next 4 years and maybe even thereafter.
The other thing where a lot of investors are expecting much lighter regulation is in the world of cryptocurrencies. How do you feel about cryptocurrencies from where you stand? And do you think that when your clients are going to Interactive Brokers, it's going to be something they're asking about more and more and more?
So cryptocurrencies are a very interesting area. We have been into cryptocurrencies for about 3 years. We charge less commission on a cryptocurrency trade than any other firm other than Robinhood, but Robinhood has a wider spread because they get their commissions paid by the market maker who they send their orders to. So I think on balance, our platform is probably the most efficient one for a crypto trader. Otherwise, to tell you frankly, I am sort of scared of cryptos because, they can go to any price because it's basically just a figment of imagination. So it doesn't have any underlying value. The only value it has is the same as the paper dollar, which is nothing.
But you've seen people pour in nonetheless through ETFs. You saw the price of Bitcoin get to $100,000. Will the investor of tomorrow be more likely to buy Bitcoin or a U.S. stock?
Well, it depends. Well, for a Bitcoin, you can buy U.S. stocks, right? For a U.S. stock, it's more difficult to buy Bitcoin, right? So I think that anybody who does not have Bitcoin should have some Bitcoin, but not too much. I would recommend that people put maybe their 2 to 3% of their net worth into Bitcoin. And we, for example, will not allow anyone to invest more than 10% of their assets into Bitcoin, because I think that would be very dangerous.
And that was Interactive Brokers Group Chairman Thomas Petterfy there, speaking to our own Shanali Basak, whom we happen to have in studio. And Shanali, that was a whole day of, Goldman Sachs guests. And I would imagine many of them were very positive on this market.
Very positive, but you heard from Thomas Petterfy, who, of course, was a founder of one of the biggest retail trading platforms. And it reminds me of sort of what Alex Semenova was just telling us a couple of days ago. The retail trader, you would think they have done gangbusters in this market. In fact, they have trailed the S&P 500. And you have Thomas Petterfy saying he's actually kind of worried about a more near-term drawdown. We're sitting here near record heights still. We're above 6,000 on the S&P 500. Investors largely shaking off those worries. But you've got to wonder, as you've been saying, what happens when you have all but one rate cut really priced out of the market at this point?
Well, I don't get the feeling that it's the retail investor that's being very wise and very patient and very slow and not greedy that's not beating the market, and maybe it's all of them, but there do seem to be a proliferation of these levered and double levered and triple levered ETFs that are, matched to Bitcoin and so on, and these are very, very volatile assets.
Something interesting to think about, too, is with a new SEC chair, Gary Gensler stepping down, and the president-elect really expecting to have a light on regulation administration, are you going to see a whole host of new ETFs with a lot of leverage out there into next year? There's another one, by the way, with private credit in its mix as well. So maybe some innovation in financial markets next year. Let's see if it's for the better.
And we also don't know how much impact any of these new chairs will have, right? And how much will they have to answer to Donald Trump, and how much will be able to get something done quickly? And if there are no staff because of the Department of Government Efficiency, then how much exactly will they be able to get done? We're going to talk more about the Treasury market in just a few moments, so stick with us right here on Bloomberg Markets with Bonnie Quinn and Shanali Basak.
You can have a baby anywhere you want. It's the environment and that care. That is what matters most.
Our investigation found some of the worst cases of harm were surfacing.
मुझे क्या पता कि भाला के चक्कर में मेरा ही बुरा हो जाएगा।
I never thought I would be vulnerable to a scam. This ruined me, and I didn't have any real good explanation for it.
Wildlife trafficking is almost always driven by greed.
Once you start focusing on money, you lose sight of what is best. That's where things go wrong.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
AI, how it has penetrated pretty much all sectors, including music. AI can write music, compose music. How do you see AI changing the landscape in fashion?
Yeah, AI definitely helped. When I did the jewelry, I used the AI, helping me to give some idea, but ultimately you still have to do a lot with it. It just give you very superficial ideas, and but at the end you still have to customize and have to really make it and do that. I do not think that AI and the technology can replace the human mind at this moment. Yeah.
Are you concerned one day we won't be able to differentiate designs by AI and designs by an actual designer?
I don't know. For me, I feel that, when a designer is doing, it's the spirit, it's the heart that the computer don't have.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, weeknights at 8 p.m. Eastern Time, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
This is Bloomberg Markets. I'm Bonnie Quinn along with Shonali Basak on this, third last trading day of the year? Shonali, already? We did this last year too, remember? We were bringing you to the end of the year. That's right.
You and I with the holiday cheer and all that jazz.
Santa Claus rally, it looks like.
Yeah, not much left of the year, but of course we are looking at the markets really try to break back into the green. But we are also looking at the bond market here, also breaking back into a little bit of green on the day, at least on the shorter end of the curve. Bond traders are bracing for 2025 now, and that is following a roller coaster year in the Treasury market. Still a roller coaster, actually. Joining us now, Bloomberg's Liz McCormick. People are not taking a breather here, it feels like. You're looking at a 10-year off that 460 level, but still above what HSBC's Max Kettner talked to us as that danger zone of 4.5%. How do you think about this moving into next year when CFTC positioning still shows you that many traders are still net short for the longer end of the curve? Are they having the stomach to stay short and maybe even go shorter?
Yeah, hi, Shonali. And I did see that Max Kettner interview, actually, and I was thinking the same thing. You know, Max said 4.5, and a lot of people thought we would crack above 4.5, and here we are, like you said, with this 4.6 and change. And I think a lot of people are feeling like, you know, as far as, like you said, people short, a lot of them are short in the curve trades, meaning they're buying the shorter end, whether it's 2s or 5s they like, and they're selling the long end. So I think that those shorts, some of them have staying power, because a lot of people, you know, even if you say, well, the Fed is still going to cut a little bit, and like you said, much of the cutting has been priced out of the market. There's less than 2 full quarter-point cuts priced in, just 1 solid one. But people think, well, the shorter end will still do okay because at least the Fed's still biased to cutting. But there's just a plethora of risks in the long end that even when you don't ask investors, they bring up on their own. Like, hey, we might like the market, but we're weary of, 10 years and beyond, because as you guys have been talking, there's a lot of uncertainty on the fiscal policy. We know, President-elect Trump will come in after the 20th. He said a lot of things, but how much gets implemented, to what degree, how fast, there's a lot of unknowns. And Fed officials, kind of surprising to many, Chairman Powell said, a few Fed officials kind of factored into their projections, and their recent quarterly projections, some kind of estimates of what might happen with the new administration. So there's just a lot at play, and you see a lot of the 2025 notes just keep saying uncertainty, and then that's like the word of the note.
Yeah, exactly. How could you even trade longer term at this point, Liz? Because there's, like you said, there's so much uncertainty. We have no idea what the Fed's going to end up doing really next year. The market's thinking something totally different than it did just a few weeks ago. And obviously we have no idea what tariffs are going to be placed on countries and how that's going to impact inflation. And yes, the data in the US is playing ball for the moment, for the most part, but it mightn't for all that much longer.
Yeah, in fact, I was speaking to a fund manager from Fidelity the other day, Vonnie, and what he said to me is everything you laid out. And he said, because of that, we're active bond traders. We're just kind of staying, like they like to say, close to home, meaning they're close to their benchmarks. They're not leaning too long or short either way. They're also biased that the curve will steepen a little bit. I don't think people want to take big swings here. There's just so many things we need to know. And you might have seen that Bob Michelle at JP Morgan asked Asset Management said we could even maybe end up surprising and treading water all year, meaning a lot of these policies don't get done and all this volatility we expect doesn't happen. So I think a lot of people are just not going too far over their skis right now. But like you saw the auctions, I think Shonali mentioned them. They did well this week, 2s, 5s, and 7s did very well. So that shows, again, there's demand. Rates are still pretty nice and high for people. You get that regular fixed coupon payment twice a year. So they like the shorter end. So I think that's what we're going to see. And then we have to see the Treasury Secretary, who President Trump, wants. Does he get confirmed? What he does? There's just a lot to be looking into in these first couple months of the new year.
I want to look even shorter term for a moment here, because even though you did see those auctions go smoothly, there's another dynamic going on when you look at repo rates, which is kind of interesting given that you saw the Fed make some changes. They adjusted the RRP facility rate further downward than initially the market had expected, yet you do see repo rates still rising. What does that mean in terms of near-term funding stresses and why we're seeing them?
Yeah, my colleague Alex Harris has a nice story about that on the screen today. And yeah, I mean, despite the Fed, and now like they always say, you don't know the counterfactual, Shonali. So maybe if they didn't do any of these, like lower the RRP, they added another standing repo facility. So now there's 2 a day for a little bit until early January. Maybe it would be worse if they didn't have that. But, remember, we've been talking repo for a lot of years, you and I, and this is, also the typical month end is a problem, usually quarter end, but now we have year end. So it's the trifecta. So people are expecting some repo pressures, but it's really, we're in just such a precarious time with the Fed doing QT and getting maybe close to the end. People have different estimates of when they may stop it, and they're Lori Logan has laid out, the Fed official, clearly like what she's looking at. And so I don't think, I'm not just pushing this off as year end. I think it's something to watch. How bad does it get, especially like you said, with these added facilities? Right now, we're not in September 2019 crisis, but I would say things are fine until they're not, right? A lot of people didn't see that coming, and that was very bad, including, some at the Fed, let's just say, weren't predicting, we're going to get close to the issues when 2019 hit in September of that year.
Well, I was just going to say, Liz, if you were playing volatility of the yield curve this year, you might have done extremely well if you got it right. If you compare the VIX to the MOVE index, the VIX, there was a couple of spikes this year, a couple of scary spikes, but the MOVE index was yo-yoing all over the place. Is there a trader out there that's done really well from this uncertainty?
Well, yeah, and it's like crazy because the Treasury yields are like the risk-free rate, supposed to be pretty stable, and we just haven't seen that this year or even last year. But I think people who have kind of hung in, and they were kind of brutally taking some pain in these yield curve trades. Some are doing them in option structures. So, it's just been a rough ride for them. But now we do have finally, how long the curve was inverted. Now we have some steepening. So I think that volatility, if you could stomach it and stay, those people who stayed in the curve steepener trades are happy now, although I won't get too wonky, but it does cost you some money to stay in there. But I think, people were surprised at how volatile sovereign yields were, right? And let's not just here, look in Europe, right? All the things going on with what happened in France with those yields, bucking up closer to where Italy is. Like, we've just seen a lot of busy trading in sovereign markets. So yeah, I think it's been tough to stomach. That's why some, like I forget they did a nice story year end what trades worked and what didn't, and one was just sitting in cash, right? Yeah. Cash kind of beat everything, right? With money market funds, which have now 7 trillion plus in it. So yeah, I think some people said, let me forget it. I'm just going to sit in cash because I'm making some money. It didn't beat the stock market, of course, but it did better than some fixed income securities.
I always love looking forward to John Authers' hindsight capital portfolio, which he does at the end of the year. He looks back on what we could have done all year if we'd only just been that smart. Liz, thank you so much for joining. That's Liz McCormick there from Bloomberg News, bond expert. Joining us now is Simeon Hyman, global investment strategist at ProShares. Simeon, we were just talking about how the retail investor has lagged the S&P 500, and I'm curious because there's so many ETFs at ProShares, and some of them levered and some of them not. How is the institutional investor potentially beating indices and the retail investor is lagging? What are they doing wrong?
Well, I think the way we're characterizing rolling into 2025 is rational exuberance. And what some folks are missing, and if they're missing, they might be missing out on the market because they're nervous, is some fundamental changes behind the profitability of the stock market. And it comes down to the following surprise. There is a lot less leverage in the stock market than there was just 20 years ago. So there is 1/3 net debt to EBITDA is the classic measure. We're from 5, we're down to like 1.25. There's a lot less leverage. Now, that means less risk. But what it also tells you is it uncovers very strong underlying profitability. People focus on return on earnings. Return on earnings isn't much higher than it was 20 years ago. But when they're achieved with 1/3 of the leverage, that means that the underlying return on assets, the underlying profitability of the S&P 500 is 4x what it was 20 years ago. So I think if you're not fully cognizant of that piece, you're looking at the market and you're saying, I can't go there. But we'll call it rational exuberance, and I think that's the missing piece that some people haven't gotten their arms around. The fact that in some ways, even at 25 times, the market may not be as expensive as the casual observer may think.
So if you're saying the S&P 500 has about 1/3 of the leverage that it had 20 years ago, where has that gone? Where is that just, risk appetite that went away, or has it moved somewhere?
People like to talk about the private credit market, and that's the kind of standard answer. But it does have, at least with respect to the S&P 500, it does have something to do with the technology sector and communication services that are just generating cash like crazy. There is a very strong cash generation aspect to the S&P 500. Yes, there's private credit out there, but with regards to large cap stocks, the leverage really has been mitigated by that incredibly strong cash flow. But what I would note is even the public credit markets are priced to perfection. If you look at the high yield spreads today over treasuries, they're less than 300 basis points, less than 3%. Historically, the average is 6. Now, when you got that average of 6, you on average lost 3% to default, so you netted 3%. That means today in the high yield bond market, if there are 0 defaults in the public high yield market, you will get less spread than on average over time net of defaults. So that's why another reason why we think risk is better taken in equities where you have upside, where the public debt market is priced to perfection.
When you think about next year, a lot of conversations are brewing about the value of diversification when the last couple of years, if you just put money in the S&P 500, you might have been better off. And a lot of people who could have captured some of that extra yield in fixed income markets sat in cash and were also just better off than maybe taking on either duration or credit risk. How do you think about this dynamic heading into next year? Do you play caution with some cash markets here, or do you find that extra way to pick out yields that's outside of the obvious?
It's a challenge because on the long end of the curve, which I would argue has been behaving rationally, Chair Powell said 2.5% inflation, not 2, and we've gone from 4.1% to 4.6 on the 10 years. So it's behaving normally, but there is risk of inflation on the long end, and that means yield up, price down. And of course, there's still some cuts to Fed funds, maybe just one more, but look, that's a salary cut for folks in those money market funds. So, and you also have the tight spreads we talked about. That does leave the income-oriented investor in a quandary, to which we think it is a good idea to look towards equity to fill some of those income needs. The problem is that some of the classic ways to do that, high-yielding stocks like REITs and utilities, they can just be kind of bonds in disguise, and they might be interest rate sensitive as well. So we're appreciative of, for example, the explosion in the covered call space to generate income that's not interest rate sensitive. And here we note for folks the S&P 500 Daily Covered Call Index, which brings daily options into play. And that's a nice way for folks to get some income that's not interest rate sensitive and keep exposure to the equity market, which, hey, yes, you gotta hold your nose a little bit, but we think it has better opportunity than the credit and the fixed income side.
Thank you so very much for joining us. Of course, that is Simeon Hyman. He is Global Investment Strategist at ProShares, setting us up for a 2025 that it may not be as obvious now that we, right before our eyes, already have, Vani, the changing expectations around interest rate cuts next year.
It's not even until July that there's actually a full cut priced in. And if you look at the end of the year, there's only 25 basis points of cuts priced in for the whole year. The market does not listen to the Fed, does it?
And that's notwithstanding what's expected out of policies coming out of the next presidential administration. Certainly sets up for an interesting year ahead. Now, stick with us because we're going to talk more about policy. We're going to talk about President Biden looking at a decision about Nippon Steel and U.S. Steel, one of the big outstanding M&A stories right now. Stick with us. This is Bloomberg.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice because the US and China have already started the race. And Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
its own bank,
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stradwatts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
Welcome back to Bloomberg Markets. I'm Bonnie Quinn along with Shonali Basak on what's one of the final trading days of the year. And we just have 14 minutes to go on this trading day, Shonali.
14 minutes to go. We're going to talk more about those markets. But before that, we are going to talk more about what to expect because the incoming Trump administration is facing its worst trajectory for federal borrowing in modern day history, with the federal deficit projected to exceed 6% of GDP next year. Earlier this month, Treasury Secretary Janet Yellen shared her concerns about the U.S. deficit with Bloomberg's David Gura. Take a listen.
Well, I am concerned about the fiscal outlook, and I believe the deficit reduction is necessary to keep us on a sustainable fiscal course. Now, President Biden signed into law $1 trillion of deficit reduction over the next 10 years. He did that in the agreement to raise the debt ceiling. And our budget proposes an additional $3 trillion of deficit reduction over 10 years. And I think that's necessary to make sure that our fiscal path is sustainable. Now, Congress hasn't really done anything to, beyond what I've mentioned, to improve the fiscal outlook, and I think that's a shame. I'm disappointed in that, and I think Congress needs to work hard on that. There is a threat going forward that many of the provisions on the individual tax side of the Job Cuts and Tax Act, JCTA, enacted by the Trump administration and Congress in 2017, they will sunset at the end of next year. And many Republicans have expressed a desire to keep all those provisions in place. CBO said that will cost $5 trillion over 10 years. So that really is, and so that would be a blow in a situation where I believe an additional $3 trillion, that not doing the $5 trillion and $3 trillion more is necessary. And if the provisions are just extended, this will be a serious blow without finding ways to pay for them. We proposed a lot of pay-fors that we think would fairly ask corporations, wealthy individuals to pay their fair share. We've negotiated an international tax agreement that would create a level playing field worldwide for multinationals. The United States has not yet joined, although many other countries have. And that would be a revenue-raising measure that I think would be very valuable. And there is certainly more. So I do hope that the new administration and Congress will, if they extend features of JCTA, find ways to pay for what they do, and also make sure that the benefits go not to the wealthiest individuals, but to middle-class families.
Treasury Secretary Janet Yellen there speaking with Bloomberg's David Gura, and it's important to notice, Shonali, this next year is going to fly by, and what the Treasury Secretary was talking about there, the tax cuts and whether they'll get extended or not, that's a conversation for the end of the year, but we have to get through so much first, from any debt ceilings and continuing resolutions, and the fact that Republicans, there's a great handful of Republicans that didn't agree with Donald Trump that the debt ceiling should be abolished.
Yeah, it's incredible because you have that posturing in Congress, but then you have that larger DOGE effort that is still very unclear. But, one thing I read back to was the Committee for a Responsible Federal Budget that has really taken to a lot of what is going on and found some places where they can look, again, they're politically sensitive places to look to offset some of the issues with the deficit, though I would say that with interest rates at the level that they are, we have to remember that just the payments on national debt alone are exceeding what you see in defense spending. So you have just an enormous cost to debt alone, let alone other areas of the government that you could reduce spending. But for now, that debt load alone is a large cost.
Shonali, I just want to bring to everybody's attention that Dick Parsons has passed away. Dick Parsons, of course, the former chairman and CEO of Time Warner, but also, as you well know, knowing your Citigroup history, the former chairman of Citigroup and a lion in business terms for decades now.
Yeah, certainly very sad moment. He died at 76 years old. The cause, according to the New York Times, was bone cancer. According to Ronald Lauder, who is on the Estee Lauder board, of course, of the Lauder family, one of the oldest friends of who is known as Dick Parsons, a very large figure in the current business world as we know it.
Yeah, exactly. Dick Parsons, once again, according to the New York Times, dead at 76. All right, let's move on now to another sticking point in Washington. One of President Biden's final acts in office will be deciding the fate of Nippon Steel's proposed acquisition of U.S. Steel. A government panel deadlocked on the deal earlier this week. Well, this morning, Nippon Steel delayed the closing date of the deal into 2025. Joining us from Washington, D.C. now is John Harney. John, will Biden get this done and decided in the next, 20, 30 days? Does it have to be done, or might it actually bleed into the next administration?
Well, he has 15 days from Monday to say whether or not the deal should go forward. He has not, he has not said flatly he's going to kill it, but he has made plenty of indications that that will be his decision. The announcement today that the closing has been put off simply faces reality. Nippon Steel has put off the closing, before this, as this huge $12+ billion acquisition has become further ensnared in American politics in the election. It remains unlikely at this point that Donald Trump will have a say on killing the deal or not, but both companies say that if President Biden says no, they will go to court, and then who knows where it'll end.
Yeah.
To that end, what happens from here? Because this, of course, is a very politically sensitive deal, has a lot to do in terms of how steelworkers in America feel about foreign ownership, and a lot to do with how the Committee on Foreign Investment, CFIUS, operates in relation to how they seek to block deals moving forward. What does it say about areas that are sensitive to the American economy as it comes to foreign investment?
Well, all those realms, if you will, are important, certainly. CFIUS, by the way, deadlocked over whether or not the acquisition should go forward, leaving it to the White House, and that was a step that had to be taken. But also, there's also international relations. Japan is not an adversary like, say, China, but a very close ally. Prime Minister Ishida of Japan today urged President Biden to approve the deal. Now, whether or not he'll do that or not, we'll see what happens. But you're right in that this became a very political issue, as many other parts of American business and culture have. Many steelworkers have this, and other Americans have a strong. There's a strong history behind U.S. Steel. It's an iconic American company, but Nippon Steel and U.S. Steel say there are many good reasons for this acquisition to go forward, apart from politics, apart from, for lack of a better word, nostalgia.
John, we have to leave it there. We thank you so much for joining us today. That is John Harney of Bloomberg News. Of course, fascinating to see this as being a deadlocked decision by CFIUS. Of course, now a decision now in the hands of the president. Of course, we know that President Trump has also been very critical, though we don't exactly know how it would go. Of course, we're not in that situation at the moment.
Yeah, exactly. I mean, Nippon Steel is so much larger than U.S. Steel. U.S. Steel, looking at this behemoth, and it would make conditions very difficult for U.S. Steel if this merger goes away. On the other hand, it's symbol on the New York Stock Exchange's X, so you can imagine that somebody else might want to weigh in even for those reasons alone. But yeah, we'll see what happens with this. We've been waiting for this decision for a long time.
Now, Lenny, I know we're moments really away from the closing bell, just the last trading days of 2024, really of a gangbusters year. The S&P is trying to stay in the green, moments away. We're going to speak to Aaron Gibbs of Main Street Asset Management next. Stick with us through the close. This is Bloomberg.
In case you missed it, on Bloomberg Open Interest.
We'd love to hear from you. We'd love to hear what you think about our shows here on Bloomberg Television. Do you think we're doing well? Do you think we need to change some things?
Do you like Matt Miller?
Should I wear a wig on a regular basis?
Please write that in. I'm scared.
The first monthly loss for the S&P in 7 months, 30 minutes until it started trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Don't miss Open Interest live weekdays.
We felt strongly that there has been an opportunity for there to be an experience on mobile that is centered around gamers. Like, we talk a lot about how there's 3 billion gamers in the world. 2 of those billion play on mobile, and half of those actually play on mobile and they play on another device. But there isn't actually a gaming platform and store experience that is centered around players and goes truly across device, where who you are, your library, your identity, your rewards, that travels with you versus being locked to a single ecosystem. And we've recognized that opportunity for a long time, but we wanted to make sure that anything we built was really grounded in people who play those mobile native games and the creators of them. And so being joined with a team that has real deep expertise in mobile was important to us.
that move markets are on Bloomberg.
Our budget proposes an additional $3 trillion of deficit reduction over 10 years. And I think that's necessary to make sure that our fiscal path is sustainable. Now, Congress hasn't done anything, beyond what I've mentioned to improve the fiscal outlook, and I think that's a shame.
Nobody covers business like Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
You can have a baby with anyone you want. It's the environment and that care. That is what matters most.
Our investigation found some of the worst cases of harm were surfacing.
मुझे क्या पता कि भला के चक्कर में मेरा ही बुरा हो जाएगा.
I never thought I would be vulnerable to a scam. This ruined me, and I didn't have any real good explanation for it.
Wildlife trafficking is almost always driven by greed.
Once you start focusing on money, you lose sight of what is best. That's where things go wrong.
In case you missed it, on Bloomberg Technology.
I believe that we would love OpenAI models inside of AWS. Absolutely. It's we listen to our customers, and if that's something that customers want, we're absolutely game. Obviously, with a partnership, it takes multiple sources, and there's probably some complexities in there, as you allude to. But I think in the fullness of time, it likely is the case.
Don't miss Bloomberg Technology live every weekday.
Welcome to Bloomberg Markets, a special holiday edition. It is a holiday shortened week. I'm Vonnie Quinn along with Shonali Basak, and we are just seconds away from those closing bells that you can hear ringing at the exchanges. And it's another up day, at least for the Dow, but we just flipped negative, Shonali, for the other major indices, including the NASDAQ 100.
Absolutely fascinating day, because you did see that drop off in the 10-year yield, but you did still see the S&P 500 led lower. The Dow Jones just in the green, the NASDAQ lower. Where you saw little levels outside of those major indexes, you saw the Russell 2000 with that lower yield story up almost 1%, about 0.9%, Vonnie. So there was green in the screen somewhere in the market, just not at those major index levels.
There were people nibbling today, and maybe at the close they were just taking profits because they're going to have a long weekend before the beginning of a new year. But joining us now to break down today's market moves is Bloomberg's Alexandra Simonova and Natalia Kaniakiewicz. So, Alex, talk to us a little bit about some of the gainers that we saw, because we did see some very, very, very happy companies today.
Yeah, Vonnie, even with the NASDAQ 100 down today, there is a technology sector that has been a big winner in this session. Quantum computing stocks broadly up across the board, a sector that has become an area of intense interest on Wall Street and certainly one to watch in 2025. D-Wave Quantum up more than 20%, Rigetti Computing up more than 30%, and Quantum Computing up more than 10%. All these stocks have seen very pronounced moves year to date, up 1,000%, 2,000% on some of these names. And again, though, it's not on fundamentals here, but on the transformative potential of the technology. Take QBTS, for example, D-Wave Quantum. This is a company with a $2.2 billion market cap and just $9 million in revenue. Another name, speaking of tech, that I'm looking at today is Apple. It's up about 0.3%. This is after its price target was raised to a street high of $325 by Wedbush Securities, by none other, of course, than Dan Ives. He says that the company is heading into a multi-year AI-driven upgrade cycle. This upgrade cycle, he says, is being underestimated by Wall Street. He has an outperform rating on the stock, of course, and even though the move today was pretty modest on this upgrade, it is up more than 30% this year. And finally, I am taking a look also at GameStop. Shares rose as much as 10% today, up about 6% into the close, and this is a of course, after a post on X from Keith Gill, also known as Roaring Kitty. You guys remember him from the GameStop saga back in 2021. This post was an image of a gift on Twitter without any text, so no real reason that the stock is moving higher, and trading volume today was almost 5 times the 20-day average for this time of day, according to data compiled by Bloomberg. The stock also rose for a 5th straight session for its longest winning streak since November 1st, and GameStop shares are up about 86% this year, guys.
Appreciate it so much. Natalia, let's take a look at the decliners on the day. We bring in Natalia Nazevich for that.
Right, so I'm looking at energy producers, guys, specifically companies that are related to natural gas industry. We see stocks like Targa. It's one of the worst performers in the S&P 500. EQT is also lower, and the main reason for that is natural gas futures. We see that natural gas posted almost a 7% decline on Thursday, and that was driven by forecasts. Now, forecasters expect a little bit warmer than expected weather in the last couple days of 2024. As a result, it always built concerns about some oversupply, and futures of natural gas move lower. As a result, we see that natural gas companies are moving lower as well. And another stock that I'm keeping an eye on is, of course, MicroStrategy. We watch closely what's been happening with Bitcoin. It's now moving lower. MicroStrategy shares are down by 4%, almost 5%. Investors are also reacting to companies' news to issue additional shares to fund further Bitcoin purchases. Just a reminder, MicroStrategy is seeking a permission to increase the number of authorized shares of Class A common stock and preferred stock. That's according to December 2023 filing. And of course, Bitcoin will be still volatile tomorrow as well, because we see a huge option expiration tomorrow. As a result, we will keep an eye on all crypto-related stocks.
Yeah, so there's going to be a lot of volatility between now and the end of the year, it looks like, Natalia. Also, the VIX index itself not showing too much fear today. The VIX was down to under 15. Of course, we know that that can move pretty quickly. So in general, we had a sort of a mixed day, about 200 stocks lower and nearly 300 stocks higher, but not hugely higher. But that's still pretty good breadth, right?
Still pretty good breadth, yes. And again, we are still looking at final trading days of this year, if we will see more potential upside move driven by the so-called Santa Claus rally. And now, as you mentioned, volatility is also on traders' radar. What I heard from sources I spoke with, next year will be a little bit different. This year was volatile. We saw huge moves in the VIX index, but they say that next year volatility will be a little bit more predictable, because it will be driven by Donald Trump's.
How can you predict volatility?
It will be driven by Donald Trump's policies, and as soon as traders know what exactly he will implement, it will cause, of course, volatility. But you can play volatility in a little bit different way and potentially gain more, because this year, for example, when we looked at those vol control funds, those funds typically follow the market direction. They were lagging because it was so hard to predict volatility moves in 2024. So lots of expectations that next year will be a little bit different.
Ladies, thank you so much for joining us today. Of course, hard at work into the end of the year. We're all just kind of wiping off our calendars and playbooks to prepare for 2025, and the end of the trade this year has certainly been strong. We're going to now be joined by Erin Gibbs. She is Chief Investment Officer at Main Street Asset Management to talk about that playbook. So you think about the gains that we've seen this year, how much the S&P has been driven by those mega cap tech names, and a lot of people are scouring the market for other opportunities. How do you see those other opportunities playing out, especially when you see how sensitive some of the small cap names have been to the interest rate movements? Today, the Russell 2000 was your relative gainer.
Exactly. I think now that we have a better sense of where the Fed is heading, we're seeing obviously a more stable inflationary environment of slow and steady. And we're also looking at reduction of fiscal stimulus. Where we're really going to see productivity are obviously potentially from AI gains, but where we might see company profitability would more likely be within some of your small caps, as some of the larger caps are starting to face some headwinds. And from an investor investor standpoint, not only am I looking at where companies might grow, where that profitability might come from, but also just where the value is. Because as we have had such big run-ups from these high expectations of increased productivity within these mega caps, there really is a lot of money on the table from some of the smaller companies, some of the lesser known companies, even within the S&P 500, where even if they just meet, let's say 15% growth, they don't have to be 20-25% growth, but they're undervalued by 25% compared to historical gains. Those are the companies that could do really well if we finally see some expansion of market breadth.
You've really started to see markets largely shake off many of the risks we've seen out there. That was interest rate risk, it was geopolitical risk, yet we're sitting here at the S&P 500 at year-end well above 6,000 still. What are the risks you're looking at next year that could particularly throw investors off this more bullish course?
So two big issues I see. One is just a slowing global economy. We're seeing some major economies really facing some headwinds. So China, South Korea, Europe. And so those larger cap companies, particularly multinational, where they do have to worry about revenue risk, they do have to worry about the dollar currencies. Those are the companies that might face more headwinds than some of the more domestic focused smaller companies. Another issue is just the reduction of fiscal stimulus. It really looks like from an economic standpoint, we're starting to hit that peak of the cycle and that the economy might slow down. So you need companies that are able to operate efficiently, that aren't so focused on the fiscal stimulus, and can really drive from other organic revenue sources, and perhaps more domestically. So those are the two big headwinds for those are slowing fiscal stimulus and then slowing global external trade that might really potentially derail some of the larger cap companies next year.
Yeah, Erin, you say earnings may start to disappoint. Does that happen already in Q1 of next year? After all, JP Morgan is out January 15th. It's only a couple of weeks away.
Yes. Well, we did have a rather low beat rate for Q3 already. And we know that analysts are obviously lowering some of their expectations for Q4. Right now, earnings expectations for next year are pretty darn optimistic. We're looking at 14% growth for the S&P 500, 20% growth for the S&P small cap for earnings profit. Those are some high numbers. Whenever we're looking at mid-teens to even 20s, they have often been revised down. So we'll see. Obviously, we have a lot to be able to deal with next year, even though at least the Fed part of that story seems to be more stable. But certainly, I think people should be prepared for disappointment. And when the stock market really is priced for perfection, as we're seeing in many of the sectors right now, particularly within the large caps, not within the small caps, investors should be very wary if we do see some weakening or some deterioration within the economy and within some of these industries.
Where do you anticipate any weakening in the economy, Erin? We haven't seen any really at all this year.
No, we've been very fortunate. And like I said, a lot of it has been through fiscal stimulus, through dollar trade. I think if some of the tariffs come through that Trump has promised, that could be a huge negative impact, particularly on materials, industrials, consumers, just a host of industries. And so that's something that I think investors should be very wary of, and just remain up to date and be ready to switch if that changes, because that type of policy could have a significant impact on companies' profitability.
For next year, what do you think your favorite trades are to set up for the new dynamic under a new president?
Yes. So one, I would like to say, again, small caps. they're a little more insulated from tariffs. They might be again more domestically focused, less exposure to dollar and currency trades. So that's one of my favorites. And again, they're such a low value, they just have less downside risk. On the other side, I do like some of the stable industrials, sort of the growth at a reasonable price. Some names like Honeywell, Caterpillar, nice stable earnings quality that can weather the storm, that can weather a few quarters of potential volatility and still beat expectations.
All right, Erin, thank you so much for joining us on this holiday week. That is Erin Gibbs, Chief Investment Officer at Main Street Asset Management, joining us there. Quite incredible how the market just turned around. We were going to be able to report a nice green day, Shonali, but we didn't get it. The S&P 500, while it's still above 6,000, was down 2.5 points. I mean, barely anything, but still.
And it's interesting, as our colleagues over there at Bloomberg News have been reporting out of the equity desk, typically between Christmas and the New Year, you do see a bit of a bump higher, a bit of a rally. We're not seeing that materialize quite yet. Of course, a lot of the sectors that were driving the market earlier in the week, you did not see, for example, Tesla was one of the bigger losers on the day today, dragged down that broader consumer discretionary index that would have seen much larger gains today, with the likes of more unloved stocks like Dollar Tree seeing a lot of love on a day that you're seeing people going to the store and buying things.
As you pointed out, Walgreen earlier on, which is higher by a couple of percent today, down 64% this year, though, in total. All right, well, we will continue to talk about this. And coming up, we have Lance Lambert as well, editor-in-chief and co-founder of Resi Club. He joins us with his outlook on the U.S. housing market. Do stay with us. This is Bloomberg.
A continent of vast opportunity and endless potential, but not without its challenges. Bloomberg highlights the players and unpacks the issues shaping the African story. We'll bring you interviews with key newsmakers and expert analysis, getting to the heart of business, politics, and economics in the region. I'm Jennifer Zabasaja, and this is Africa Amplified.
AI, how it has penetrated pretty much all sectors, including music. AI can write music, compose music. How do you see AI changing the landscape in fashion?
Yeah, AI definitely helped. When I did the jewelry, I used the AI, helping me to give some idea, but ultimately you still have to do a lot of it. They just give you very superficial ideas, and but at the end you still have to customize and have to really make it and do that. I do not think that AI and the technology can replace the human mind at this moment.
Yeah. Are you concerned one day we won't be able to differentiate designs by AI and designs by an actual designer?
I don't know. For me, I see that, when the designer doing is the spirit, is the heart that the computer don't have.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Welcome to Bloomberg Markets. I'm Bonnie Quinn along with Shonali Basak. Today, one of the final trading days in 2024. It's been a tough one for housing stocks and for those who might want to get on the housing ladder. Many have speculated, in fact, that falling rates this year would lead to the bottoming of the U.S. housing market. So what's in store for home builders heading into 2025? Joining us to discuss is a Bloomberg News stock market and real estate reporter, Nora Melinda. So Nora, what is the outlook just broadly for the home builders, be it the high-end home builders or the low-end home builders, the introductory offer home builders?
Well, it's been a bit mixed, Bonnie. I mean, of course, we know home building stocks have really been on a tear over the past couple of years, and that's because they've been taking market share from the existing home inventory that tends to be the most popular inventory when you think about a home buyer. They're looking for a used home. Well, because rates have been so high and the mortgage rates have been unbearable for people to actually take out a loan and go get a house, we're actually seeing a lot of home builders profiting off of this instance. And so we are seeing, as we head into 2025 and as we think about the Federal Reserve and its rate outlook, it is a bit of a mixed picture for home builders. And I want to talk about the ultra luxury side of things. So we have companies like Toll Brothers. They cater toward luxury homes and buyers of that nature. Well, actually, when we think about the fact that a lot of these high net worth individuals are actually using collateralized lines of credit, it's actually money-like capital. And so as some analysts are actually becoming a bit bearish on the stock market heading into 2025, they don't really think that that will be a big bright spot for the home building industry in the luxury space.
Is there any bright spot? Because you did see this as a place that investors really wanted to get back into. And of course, you do see areas of the real estate market getting harder hit than others. Office, obviously, for example, being one of those areas. But you keep on hearing, Nora, that prices are bottoming. Prices are bottoming. If that's true, then why aren't you seeing the love in stocks associated with some of these types of buildings?
Definitely. I mean, I think you can call out things like single family rentals. So in that space, we are seeing people who are pretty bullish on the space heading into 2025. And that's because people are interested in getting a home, but maybe not buying a home. So you'll see people going towards single family rental properties as a way to kind of bridge the gap between renting an apartment and actually purchasing a new home. And then, as you mentioned, in the commercial real estate space, of course, that's been topical over the past few years, and people have been really thinking about the idea as to whether or not they have access to capital and if they're able to work with these regional banks to get the funding that they need to keep these projects going. Well, we are hearing analysts and who are really actually excited about office REITs heading into 2025. Now, of course, this has been a really beaten down sector, but if you look at this past year alone, they've actually seen their best year since 2019. Of course, that's coming from the aspect that they've really been beaten down and discounted names. But as we're heading into the new year, we are really seeing a divergence between high-end properties and lower quality office buildings.
Nora, what geographies have done the best this year? Are there some that really didn't notice any kind of downturn or noticed it less?
So New York City actually has been doing better. So not the best that it's done, of course, but I mean, we are seeing a bit of an uptick when we think about the vacancy rates of New York City buildings. And particularly, we're seeing more of a surge on Park Avenue, which of course we know is one of the ritzier parts of New York City in terms of the office landscape. I mean, back in the day, we were seeing during the pandemic, Blackstone and other companies that were fleeing this area, but now it seems that they are trickling back in. So right here in New York City, that's where we are seeing a bit of a pickup.
Nora, we thank you so much for all your time, all your reporting, all year long, really. That is Nora Melinda of Bloomberg News. We're going to get more on the housing market in 2025. We're going to bring in now Lance Lambert. He's the editor-in-chief and co-founder of Resi Club, and he looks, of course, across the entire United States for granular data of what's happening on the surface, because, of course, not all markets are created equal. Lance, if you think about this kind of larger housing affordability crisis that many Americans are feeling in real time, where is the worst of it?
Yeah, so with housing affordability, it's really deteriorated at a historically fast pace over the past couple years. That's due to an overheating of prices that occurred during the pandemic housing boom. That's due to the rate shock that we saw going from an average 30-year fixed mortgage rate of 3 up to 7 very quickly. And that's also happening at the carrying costs like property taxes and home insurance, which are lagging behind the overheating of prices. And this deterioration of affordability, what's occurring in the market is the housing market is still trying to stomach it. And so if you look across the market, you will see pockets of the U.S. housing market on a regional level that are still fairly tight and still have fairly elevated home price growth. A lot of these are in the Northeast, a lot of these are in the Midwest, some in Southern California. And then if you turn and you look at some of these boomtown markets in the Gulf, in the Mountain West that really overheated during the pandemic housing boom. They had a lot of migration, and that's since decelerated, increasing the demand shock to the market. The fundamentals there and the local incomes are having a little harder time supporting these new prices. And there's also the fact of even more increase to the carrying costs like home insurance shocks And these Sunbelt markets, a lot of these markets in Florida, Texas, they have a lot of single-family home building. And so as builders try to maintain sales volume and do affordability adjustments like bigger buy downs, bigger incentives, maybe even outright price cuts, that draws the attention of home buyers who would have otherwise looked at the resale and existing market. And so putting upward pressure on inventory growth in some of the resale inventory markets across these Sunbelt markets. And so we still see elevated price growth in a lot of the Midwest, Northeast, and then more cooling, even outright corrections in some areas of the Gulf and Mountain West.
So you're talking about places like Texas and Florida that are actually experiencing more hardship in their housing markets now. Is that what you're saying, even though they got more inventory? Just break it up into little pieces for us.
Yeah, that's right. So when inventory grows, the reason that it's growing is that demand is no longer absorbing it at the same rate. And so it's beginning to stack up. And it's not necessarily getting to really high historical levels, but it's gotten enough up and it's cooled enough to get it up that it's created a softening in many of those regional housing markets in and around the Gulf, places like Florida, places like Texas. And the builders that have spec inventory in some of those markets like Austin, San Antonio, Cape Coral, Punta Gorda, they're having a little harder time moving it. And so they're having to do bigger incentives and bigger price cuts to get it sold.
So if you're thinking about that dynamic where price cuts are starting to hit the market, how do you think about this in terms of interest rates? Because when you're seeing rates still so elevated, there's this expectation that most buyers wouldn't be able to come to the market until you got well below 5%, yet we're nowhere near that.
Yeah, so where rates are, it is certainly a strain on the housing market, both for the buyers and really the sellers, because there's a lot of people who have 3-4% rates that would like to sell it and buy something else, but they're not going to do it at a 7% rate. And so it's not only keeping a good number of buyers out of the market, suppressing housing demand, but it's also suppressing churn. People who would like to sell their house and buy something else. And the two have come together to really create a very suppressed level of existing home sales. And so 2024 is going to be right around the lowest level for existing home sales since 1995. And if you population adjust it, it's like a low for like 40 years. But on the other side of the coin, new home sales are not down as much. They've been far more resilient, and that's because builders don't have a lock-in effect, and then builders, when and where needed, like Lennar stated last week, they'll do affordability adjustments to maintain sales volumes.
Really quick, Lance, top 3 markets for 2025.
Yeah, I think if you ask me what are going to be the top 3 housing markets for 2025, based on inventory and price growth, I'm going to say Hartford, Connecticut. I'm going to go with Chicago, Illinois Metro, and then give me Milwaukee, Wisconsin.
All right. Well, I'm not going to put money on any of those, Lance, but I'm happy for you to make those forecasts, and we'll be chatting to you again in the new year. Very, very much looking forward to it. That is Lance Lambert, Editor-in-Chief and co-founder of Resi Club. It's an in-depth tracking, reporting and analysis of regional housing markets, so he really has his finger on the pulse. Well, this holiday season was definitely one to remember. We're going to be talking something I don't know much about. Our next topic, actually, Shonali, it's menswear. Do you know much about it?
I'm trying to learn about it.
Well,
a lot of Christmas presents.
We have somebody who's been that's true. We have somebody who's been doing really, really well. He is CEO of the apparel brand True Classic, and they've been signing agreements with Target, among others. And so the CEO is going to join us next. He'll explain everything we don't know to us. This is Bloomberg.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice because the US and China have already started the race. And Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
Its own bank,
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, weeknights at 8 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
We felt strongly that there has been an opportunity for there to be an experience on mobile that is centered around gamers. Like, we talk a lot about how there's 3 billion gamers in the world. 2 of those billion play on mobile, and half of those actually play on mobile and they play on another device. But there isn't actually a gaming platform and store experience that is centered around players and goes truly across device, where who you are, your library, your identity, your rewards, that travels with you versus being locked to a single ecosystem. And we've recognized that opportunity for a long time, but we wanted to make sure that anything we built was really grounded in people who play those mobile native games and the creators of them. And so being joined with a team that has real deep expertise in mobile was important to us.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Welcome back to Bloomberg Markets here with Vonnie Quinn and Shonali Basak, the fourth last Bloomberg Markets of 2024. We'll be saying 2025 and signing those checks with a different number in just a few days. It's really, really difficult to believe, Shonali. But we did close out the session sort of mixed, like a little bit meh.
We are kind of meh on the day, that is for sure. It's funny, I was just chatting on the side with some of our equity reporters, and that year-end Santa Claus rally, we certainly saw it in full steam the day before Christmas, but it has fizzled, and some of the biggest gainers on the year, say Tesla, we're actually down on the day. Let's see if we get that bid back tomorrow.
Yeah, exactly. Yeah, exactly. All right, well, retailers in the spotlight now, too, during the holiday season. Back in November, Bloomberg's Romain Bostic and Scarlett Fu spoke with Bloomingdale's CEO, Olivier Bron, on increased competition and the outlook for the department store. Have a listen.
The models in Asia and Europe right now are really flagship focused. So I think that's one big difference. And honestly, I think the flagships will have a bright future in the next 10, 20 years. It's not, I think, a problem at all. I think the problem here is managing such a large footprint. And that can be a challenge sometimes. At Bloomingdale's, we have the chance to be in prime locations and prime malls, so very strong locations. We have a limited footprint. So I think we have more opportunities than threats for Bloomingdale's in the future. I really do think that actually the department store model has a bright future, but it has to reinvent itself from the perspective of the customer, but also from our brand partners. We have to be relevant for our brand partners and rethink the model from this point of view.
How about the broader retail landscape overall? Are there too many stores in the U.S. overall?
When you look at just the pure market data, when you look at the overall market is actually slightly growing, the penetration of online is going up. So for sure, the average productivity of the square feet overall in the US is actually slightly decreasing. So yes, there will be probably some losers. It's why you have to challenge yourself and reinvent your model to remain relevant for your customers, but also for your partners.
I have to ask you, when you look at other retailers, and it doesn't necessarily have to be a direct competitor, who do you envy most? Like when you walk into their stores or you shop on their website, who do you just say, wow, they really got it right. I want to try to emulate some of this.
No, first, I really think that actually Bloomingdale's is doing that right. When I discovered the model, I'm sorry to say, but I'd say, no, but it's not the only, it won't be my only answer. But actually, honestly, I was very surprised by the level of engagement of the customer. The relationship that we're building with the customer and with our partners is actually good. And I think we can even do better in the future. But I think there's a lot of source of inspirations from our competitors, but also from other models right now, whether it's in terms of service, in terms of brand mix, in terms of events and activations. There are a lot of inspirations that are in retail and beyond retail. I don't want to give you any names, but I have a lot of source of inspiration actually in the US, but also abroad, which is another thing. I think we should not be too domestic focused because we're going to miss probably some good trends that are happening somewhere in the world.
And you think that maybe what we see abroad in terms of their approach to department stores and just retail overall, you think that's going to be palatable to a U.S. audience?
I'm absolutely convinced about that. I think, we have to bring the best of both worlds, and I think this is where we're going to perform and bring something different for the customer. The customer is ready right now for something different, more inspiring, and this, we can get it from some of the countries or some of the other models in the world.
And that was the CEO of Bloomingdale's, Olivier Braun, sitting down with Bloomberg's Romain Bostic and Scarlett Fu. We're going to stick with retail because U.S. retail sales this holiday season rose 3.8% compared to last year. That's according to data from MasterCard's Spending Pulse, showing that consumers were more willing to spend in-store and online if promotions were there. And it's exactly the type of momentum that brands like True Classic are hoping to bank on. The menswear brand is expanding its business across the United States. It's partnering with Target. Joining us now is the CEO of True Classic, Ben Yahalom. And, Fanny and I were talking about this, menswear. Where do people like to traditionally buy? It's interesting that you've partnered with Target more recently, but are they going into the store? Or are they going online to do it?
I would say very similar to what Oliver shared, that the e-com penetration has been rising over the past few years, but all in, it's still very much the case that the majority of clothing is being purchased in a physical retail location, namely over 60%.
How did you get to 500 million in revenue in just 4.5 years? A new brand, nothing in its background to prove itself. So how did it happen?
It's a fascinating story. We pride ourselves on focusing on people, and we want to make sure that they look and feel the best.
Ben, everybody says that. They all say it's always about the people, and the people are special, and our customers deserve the best. But how do you actually prove that? What are you giving to the people that they were asking for and weren't getting?
Great product, great service, great price point, great marketing. Product, we really nailed it with a perfectly fitted shirt that feels great, offered at a good price point. They love wearing it. They vote with their dollars. From a marketing standpoint, we do amazing ads that truly engage with our customers, tell them why they should care about us, how it's going to make them feel a sense of confidence, feel a sense of self-esteem, and they love that. And from a price standpoint, we offer them a premium clothing option for a fraction of the price of alternatives out there. And everybody loves a good value, and we like delivering that consumer surplus. From a distribution standpoint, we've done everything online on the main first few years, and now we're moving on to retail. So early days, it's been very much direct to consumer, and now we're on this path towards an omni-channel global brand.
So who is your customer? What age is he? How much does he make? And how tall is he?
Okay, variety of customers. I would say the core one is a 34 to 54 years old man, HHI over $100,000 a year, across the United States, majority in like California and Texas and New York. But now we have expanded internationally, so we have customers across different heights. We do have a decent number of customers in the United States, over 27% who are pretty tall, north of 6 feet, 2 inches. And all in, it's not just him, but also her who buys for him. And she buys for her dad, she buys for her husband, she buys for her son, and she's a very important customer to us as well.
When you look at your website right now, the few things that are on it at the top of the site, number one most liked, Staples 6-pack t-shirt. It was almost $180 for the pack, but you can buy it now for under $100. Same for the classic 3-pack. It's marked down from $90 for the 3-pack to less than $60. Are these really just holiday promotional drawdowns, or are you finding a consumer that is quite concerning? Do you need to keep discounting into the new year?
Yeah, those are our pack discounts. So if you were to buy those items individually, those would actually retail for $29.99 a shirt. But when you buy them in a pack, we benefit from stronger unit economics, and we're happily providing those benefits over to the customer. So those are meant to incentivize consumers who are willing to buy in bulk to do so, and therefore benefit from a steeper promotion and a steeper discount.
How often are you finding people take advantage of those discounts right now? Because you mentioned pricing was one of your competitive advantages. Is it because you're able to benefit from those unit economics, or are you finding that there's an optimal price for a t-shirt right now?
I don't know if there's an optimal price for a t-shirt, but I would say that the American consumer, and I would say probably globally as well, are tired of overpaying for premium goods, and they are looking for options that don't compromise quality, but offer that to them at a reasonable price point. And that's exactly the area we play in.
So talk to us about margins, where you make most of your clothing specifically. I don't mean where you put the tag on, I mean where the actual product gets mostly made, and how concerned are you for next year and tariffs?
We have been already prepared for that for quite some time with the tension between the US and China. And we used to be primarily sourcing our products from China, but we've diversified away. And at this point, we're pretty well diversified. We manufacture in Cambodia, in Vietnam, in Egypt, in Turkey, in Mexico. And we have the ability to shift our supply chains to different vendors, different manufacturers worldwide to ensure that we are not in any particular pickle with tariffs, duties, or even importation issues like we just had last week with a pretty big gift from the Mexican government, who overnight just decided that we're not allowed to import more goods over there, which is significantly impacting many e-com brands like ourselves. But we have good options to mitigate against that.
So, Ben, what is the secret? Because you've been also at Meta and you've helped the hypergrowth of other companies. You're 4 years at Meta, and you know how to leverage Facebook and Instagram marketing strategy. And it seems that those are the strategies that work best these days. Consumers, whether it's women or men, seem to be getting targeted more on those platforms. Is that the success to True Classics so far? Is that you've been able to do that? And if so, what advice would you give other brands?
Yeah, I would say that those platforms are definitely the main ones, Meta, Google, etc., to get a brand off the ground these days with relatively limited resources. For us, we were able to bootstrap this company. To your point, no X factors, no celebrities, no big VC money, and grow it north of 9 figures in 2 short years and do so profitably on the back of digital advertising. So yes, highly recommend for any brand who is trying to get off the ground to invest in really understanding how to leverage those platforms to their advantage. But it's not magic. You have to have a great product. You have to have a great service. And you have to ultimately find that product market fit with that advertising model baked into your business model. And when we did that, and we are not just advertising the product, we're telling great stories. We're connecting with humans on an emotional level. We explain to them what is the benefit of our product, how they're going to feel in our product, not just what is the product. And that makes a huge difference. So for us, creative content, storytelling, excellent customer service, exceptional quality in our products are all pillars of ultimately finding that product market fit and fast growth.
So when you think about all of those social media platforms, and by the way, I'm a total sucker for buying on those platforms, so I know what you mean, but
we all are.
How do you kind of kick through the noise? Because of course there are a lot of people selling on Instagram and on TikTok. So how do you get your story through without, as you were talking about, those celebrity names, for example, attaching to the brand?
I think it all goes back to storytelling. And if you really zoom out and look at that, what gets you is someone who is able to hit the nail on the head, whether it's a motivator or a barrier to start a journey with a new company or buy a particular product. So for us, it's always been, for example, like really illustrating very well the fit and the feel and how that shirt is going to look on you when you try it on, and do so in an authentic way with influencers and customers who tell those stories better than we can. And with that, people actually pay attention and they want to give it a try. And when they come to our site and they see over 200,000 five-star reviews, when they see that growing community of almost 5 million people worldwide and how much they rave about it, they want to try it, especially when the price tag is not particularly high. So you have got to kind of figure out a way to your point, like stand out and differentiate yourself. And I would say on the media side, it's absolutely about storytelling. And then from a product and offer standpoint, that's where your website has to shine.
How much does philanthropy matter? Because you donate T-shirts to homeless veterans, shelters, schools each month. Is that a big part of the story for you and what people are attaching to?
Incredibly important. But what I would say for us in particular is like we're actually not, if you will, like advertising and particularly forefront about that. We do that because we want to empower people to look good and feel good. And we genuinely want to do so not just with the clothing we sell, but also in ways where we can deliver great clothing to people in need. And most recently around the holidays, we donated almost $10 million worth of retail value of inventory to many people around LA who needed those clothes for the holiday season. So I would say it's important for us as humans because we believe in showing up to humans and in giving back. But I wouldn't say it's a core pillar of the story of the brand and how we've been showing up. I would say that still to this date, probably many people amongst our customers don't even understand or know the extent to which our philanthropic efforts have gone. And that's something we should probably do a better job articulating to them. But I would say it's important to us as humans.
Ben, thank you so much for joining, and all the very best. Your partnership with Target expanding, and that has been Yahalom, their true classic CEO. And I got on the website as well, Shonali, and I have to say everything looks very comfortable. Those joggers look comfortable, and the colors are pretty, you know, easy on the eye.
We haven't gotten to talk about it, but there are a lot of brands that are kind of tapping into this more casual market, if you will. Vuori, for another one, is another one that's taken off absolutely in recent years. You have to wonder how many of them are starting to tap this market and what kind of demand it is, especially as people go back to work. You would imagine more of that happening next year.
And I also think the fact that there isn't a logo plastered all over it really makes a big difference.
I enjoy that.
All right, well, coming up, we're going to talk Netflix and its big bet on live sports. We'll break down the streamers' Christmas Day double header with a little sprinkling of Beyonce. Next, this is Bloomberg.
You can have a baby anywhere you want. It's the environment and that care. That is what matters most.
Our investigation found some of the worst cases of harm were surfacing.
मुझे क्या पता कि भाला के चक्कर में मेरा ही बुरा हो जाएगा.
I never thought I would be vulnerable to a scam. This ruined me, and I didn't have any real good explanation for it.
Wildlife trafficking is almost always driven by greed.
Once you start focusing on money, you lose sight of what is best. That's where things go wrong.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
In case case you missed it, on Bloomberg Open Interest.
We'd love to hear from you. We'd love to hear what you think about our shows here on Bloomberg Television. Do you think we're doing well? Do you think we need to change some things?
Do you like Matt Miller?
Should I wear a wig on a regular basis?
Please write that in. I'm scared.
The first monthly loss for the S&P in 7 months, 30 minutes until it started trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Don't miss Open Interest live weekdays.
Welcome back to our Bloomberg Television and radio audiences. I'm Sonali Basak alongside Vonnie Quinn, and we are keeping an eye on Netflix because it broadcasted its second big experiment in live sports just yesterday with 2 Christmas Day NFL games and a very high-profile halftime performance from Beyonce. Netflix is just one of many streamers and advertisers who want to cash in on sports. Earlier this week, we talked to Mountain founder and CEO Mark Douglas about the shift from streaming to sports.
The big thing is that all of the major streaming networks are streaming first now. And that, you could see that like in meetings I had with a lot of networks during the year, they went from like, what do they do about their linear business to they're just entirely focused on streaming, consider linear legacy business. And I think all of them see, and when I say all, I mean Disney, obviously Netflix, others see it as a real big growth opportunity for the first time in a long time for the industry, because this industry has been so dependent on a small number of very large advertisers, and now that customer base is broadening very rapidly.
What will be the next catalyst for advertising? Obviously, the election was a huge one, but we need a new one now.
Well, I think ESPN really going all in on streaming. That's happening in 2025. I think that's a big deal. Sports, any sports content tends to do really well. You see Netflix bringing WWE to Netflix. I think it's going to be a great moment. And that's only like less than 2 weeks away. So you're just going to see a lot more sports content. I think Disney and others are really stepping up in terms of, are going to step up in terms of the amount of content. But it ultimately is all about sports right now. Just people, the advertisers just love sports content.
Yeah, Mark, I mean, it's very easily break upable into the different demographics. So it's TikTok for, you know, up to a certain age, then it's maybe Instagram, then Facebook, and then, you know, the very oldest among us, perhaps the actual newspapers and TV stations.
Yeah, well, one thing to keep in mind is more people watch TV a day than use social media. So about 3.5 billion people worldwide use social media daily for an hour, and 5.5 billion people a day watch TV, and they do it for 3 hours. So, you know, feels like Instagram, like social media is the new medium, but it's a small ad that you can swipe by really easily versus an ad on a, you know, it's on a 6.5-inch phone screen versus 65 inches on your wall, and more people watching it and doing it for longer. So TV is not only holding its own, it's making a comeback in terms of providing both the reach, the targeting, and the big screen with 30 seconds of time to get your message across as an advertiser. That's really appealing. It's very, very appealing for.
And that was our conversation earlier this week with Mountain CEO and founder Mark Douglas. Netflix's Christmas Day NFL debut going off then without a glitch, highlighted by Beyonce's star-studded halftime performance. And I do want to point out that Mariah Carey also took part. She opened the doubleheader with a performance of All I Want for Christmas Is You, but it was taped. Let's bring in Lucas Shaw now, who knows everything Hollywood, streaming and beyond. Lucas, can we say it was a wild success for Netflix? When will we know numbers?
We'll know numbers in about an hour, I think. Sometime later this afternoon, Netflix has said that they'll release it. And unlike with the Paul Tyson fight, I believe these ones will be authenticated by Nielsen. At least the U.S. numbers will be. Netflix may put out a global number that will look really big and impressive, because obviously they have more than 250 million customers worldwide. I think just the fact that it went off without a hitch already makes it a success, and we know that because it's the NFL, even if the 2 games weren't great, that the viewership numbers on Christmas are going to be pretty strong.
Well, it's interesting. I love to see what else was around the show. For example, its own commercials for other programming ahead, as well as any other commercial money they brought in. I mean, Lucas, ultimately, when you look at what they've been doing in terms of live programming, how does it set the stage for 2025 in terms of Netflix's ambitions in this space?
Well, it's really important in terms of their advertising business. You know, you look at Netflix and its growth for most of its history, pretty much all of its history, it's been a one revenue stream business. That's just subscriptions, right? It's just how many customers can we add and how much can we charge them? They introduced advertising a couple of years ago. It's been pretty slow going, partially because it was only an option for new people to sign up, right? Like they didn't force advertising on a lot of other people. Sports is where they're starting to do that. So, you know, when I pulled up the NFL game, it gave me the notification, hey, the NFL is one of these things we're going to show you where even though you pay for an ad-free tier, you're going to get advertising during it. And so they can suddenly expose tens of millions of Netflix customers to advertising. And as they add in WWE, which will have advertising, that's a lot of new inventory that they can sell and a lot of potential revenue for this company.
Exactly, and to a certain extent, Lucas, they're auditioning for all of these sporting events as well, right? So they have obviously the 3-year contract with the NFL, but they presumably, if it goes well, would like to extend that, and so they want to impress the NFL even as they sort of own it at the moment.
Yeah, I mean, look, Netflix has been very cautious in its messaging on this. I think largely because they don't want to get a bunch of sports leagues coming to them, you know, trying to get them to write a big check. They also don't want to spook investors into thinking that Netflix is suddenly going to start spending billions of dollars a year. But this is a company that does what they say, you know, walk, crawl, run, or I should say crawl, walk, run. And they also test things, right? So they do their boxing, they do tennis, they do football, they do little things to build up. There's a negotiation that's going to happen next year for UFC rights. Could Netflix play there? There's not a lot of other huge rights for them to do down the line, or at least in the next couple of years, but I expect Netflix will bid on NFL, NBA, MLB, major sports in the future, and what they're doing right now is just a proof of concept because they can deliver an audience more effectively than any network out there, including CBS, NBC, and ABC.
Well, what's interesting to me about this, too, is kind of the expansion of audiences for some of these sports teams. I mean, you take it just, you know, your microcosm of me. I'm a new football fan, apparently, this year. More women watching football, more people betting on these sports as well.
And internationally, too, Shonali.
And
I mean,
internationally.
200 countries, and apparently, you know, so many of them watched the first game. They may not have been able to stay up in certain geographies or time zones for the second one.
Or even if you just watched it for the Beyonce Cowboy Casual, right? And so if you think about these numbers that you said you'd expect this afternoon, when people are watching it, other rivals, who, if say it is a success, who should be afraid? Who does this really impact the most at the end of the day?
Well, it's potentially bad news for the traditional broadcasters, right? You know, Amazon has made the biggest splash in sports of any streaming service. I don't think they look at Netflix as too scary. You know, obviously Netflix is a bigger streaming service, but Amazon has bottomless resources. If it really cares about sports, it could outbid anyone for just about anything. But if you're a CBS, if you're NBC, if you're Fox, if you're companies that currently have NFL rights, and Netflix suddenly delivers a bigger audience than you do for the Sunday afternoon game or the Sunday night game, that's worrisome. Now, they have these rights locked up into the 2030s, right? But that's not to say that, you know, the NFL created this Christmas Day from scratch and sold it to Netflix. They could try to create more things to sell to Netflix. They could try to sell Netflix some international rights. There's lots of ways that this league that is keeping a lot of these broadcast networks afloat could get in business with media companies' biggest rival. Now, I have to ask Shonali, what prompted you to get into football this year?
My boyfriend. I said the Packers was the one team that he could have because it was the one sport that I was unspoken for. But now he's trying to convert me away from the Yankees as well and the Knicks, and I think we're going to have a problem there.
Oh my gosh. Does this guy got to go? Do I got to give him a message?
I'm not that weak. And so, but to that end, also, you're thinking, Lucas, about kind of the other sports opportunities. You named a few out there. I think a lot of people, investors in particular, you think about big name private equity folks getting into things like the NFL, driving up values even more. But if you go outside of the NFL, NBA, is the promise as there as some of these other more mainstream sports?
Well, look, we'll see, right? Netflix just did a deal for the Women's World Cup. It's placing a bet in that respect on women's soccer. I think there's a lot of enthusiasm around women's sports in general. Ratings for women's college basketball are way up. Ratings for the WNBA are way up. Now, the WNBA rights are spoken for as part of the new NBA contract, although I think there might be some games available outside of it. I think the Formula One deal is coming up somewhat soon. Netflix has obviously been instrumental in the rise of that sport, at least its growth in the U.S. So there are these these other sports on the side, when it comes to mass viewership, it's the NFL and then everything else. College football is second, and then you've got sort of competition for third between NBA, MLB, and some other sports, depending on how you think about it. But the NFL and college football are far and away the biggest.
As long as Mike Tyson doesn't appear in anything else, then I'm good.
But to Lucas's point, the Netflix can mint its own stars as it did with F1. Lucas, we thank you so much. If you don't read Lucas's newsletter, you should be. I read it every time it drops. We thank you so very much. Happy holidays to you. Vani, that does it for us for Bloomberg Markets. What a crazy close. Until tomorrow. Yeah. And maybe we'll see that Santa Claus rally reappear. We certainly saw it before the holiday.
Yes, manifesting now.
Manifesting it. For tomorrow. For Bloomberg Markets, I'm Shonali Bassick alongside Vani Quinn. Have a great night.
Names that move markets are on Bloomberg.
Our budget proposes an additional $3 trillion of deficit reduction over 10 years. And I think that's necessary to make sure that our fiscal path is sustainable. Now, Congress hasn't done anything, beyond what I've mentioned to improve the fiscal outlook, and I think that's a shame.
Nobody covers business like Bloomberg.
AI, how it has penetrated pretty much all sectors, including music. AI can write music, compose music. How do you see AI changing the landscape in fashion?
Yeah, AI definitely helped. When I did the jewelry, I used the AI, helping me to give some idea. But ultimately, you still have to do a lot with it. To just give you very superficial ideas, and but at the end, you still have to customize and have to really make it and do that. I do not think that AI and the technology can replace the human mind at this moment. Yeah.
Are you concerned one day we won't be able to differentiate designs by AI and designs by an actual designer?
I don't know. For me, I see that, when the designer doing is the spirit, is the heart that the computer don't have.
In case you missed it, on Bloomberg Technology.
I believe that we would love OpenAI models inside of AWS. Absolutely. It's we listen to our customers, and if that's something that customers want, we're absolutely game. Obviously, with a partnership, it takes multiple sources, and there's probably some complexities in there, as you allude to. But I think in the fullness of time, it likely is the case.
Don't miss Bloomberg Technology live every weekday.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice because the US and China have already started the race. And Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
its own bank,
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?